Dividend investing is a strategy where investors focus on purchasing stocks that pay regular dividends, which are a portion of a company's profits distributed to shareholders. Dividends are typically paid on a quarterly basis and are often seen as a sign of financial strength and stability within a company. Now, inside dividend investing, there's this tactic that investors often use to rapidly increase their wealth, and this is called the dividend snowball effect. The dividend snowball effect is when you have shares of a company that pays you a dividend and you use that dividend to buy more shares, therefore increasing future dividend payments, creating a self-feeding loop of increasing wealth. Not only does the snowball effect increase your wealth over time, there's other components that assist the snowball in wealth creation. That is capital appreciation, that is when the shares of a company you bought increase in value over time, and the other component is dividend increases. This is when the company has so much profits that the payout of your dividends increases even if you don't buy more shares. So these components do increase your wealth over a long period of time. Let's take a look at the numbers. So at the time of this recording, I was using SPY as an example with a share price of $518.17. For this scenario, the starting amount is $10,374, which is 20 shares, no additional contributions, 7% price appreciation, 4% dividend increase, tax rate 0, and no dividends reinvested. We can see how in the first year, we ended with $11,000. After 35 years of compounding, the money grew to $110K and makes $5.5K in dividends a year. Changing things slightly, same scenario as before, the difference will be that the dividends will be reinvested. Final balance at year 1 remains at $11K, and as we scroll down, we can see the numbers at a higher amount than the previous scenario. Ending value after 35 years is $286K with $13.6K in yearly dividends. But what happens when you add contributions to the mix and continue to reinvest your dividends? That's when the real magic happens. Invest $1,200 yearly. In the first year, we end up with a final balance of $12.4K, and after 35 years, we get $636K in final value and making $30K in yearly dividends. This is how the three scenarios look in a chart. Just changing minimal details between them causes a positive compounding effect over the long term. The endgame comparison between the red, which has no contributions and no dividend reinvested, versus green, which is contributions plus dividend reinvested, almost $500,000 in difference from their ending value. The same we can observe with the yearly dividends. No contributions, no dividend reinvested, around $5,000, dividend reinvested only around $13,000, and contributions plus dividends reinvested around $30,000. From $5K to $30K, it is a huge chunk of a difference just by contributing $100 monthly and reinvesting your dividends. The power of dividend investing and the snowball effect can truly be transformative for your financial journey. By choosing strong dividend-paying companies or ETF, reinvested dividends, and allowing the magic of compounding to work over time, you're just not investing. You're building a growing stream of passive income that can potentially support your financial needs and goals. Remember, dividend investing is not a get-rich-quick scheme, but rather a long-term strategy for wealth accumulation and preservation. The dividend snowball effect is a testament to the power of patience and consistency in investing. And as we've seen in our examples, over time, the effect can be substantial. I hope everyone enjoyed this video. Hit like and subscribe if I provided value. Stay consistently invested. And as usual, thanks for watching.